What's up everybody, I'm Jaspreet Singh, and a few months ago everybody kept talking about the market crash and how hard the stock market was going down because the Federal Reserve Bank was on the verge of starting to raise interest rates. And recently the Federal Reserve Bank has done two back-to-back record interest rate hikes, and markets over the last month have not been crashing, they have been rallying. The recent event that has been helping the market to rally was the better than expected inflation report, which came in at a whole 8.5% inflation. And that's kind of a funny thing to think about because just a couple months ago, 2 months ago, we got a record high inflation number. Back then, 2 months ago, it was at 8.6%, just 0.1% higher than where we are today. And when we saw that 8.6% record high inflation, everybody and markets got scared because of how high inflation was, and that 8.6% inflation number caused markets to crash. Today, the 8.5% inflation number is causing markets to rally. It's almost like here in Michigan where 60 degrees feels hot when you're in winter, but it feels cold when you're in the summertime. At this point, you kind of have two different extremes of opinions about what's going to be coming next. You have one side who's saying that the stock market is going to rally, that this market crash is over, that the economy is strong and inflation's on the way down, and that everything is good. And then you have the other side which is saying that this is the bear market rally, it's just temporary, and that things are about to get worse. This is where the majority of people are freaking out trying to figure out which direction it's going to be, and it's causing people a lot of stress and a lot of anxiety. But the reality, if you want to be a successful investor, is it doesn't matter, because now you have a strategy, and all these things happening in the short term don't really make a difference because you have a strategy and you know how to implement the strategy no matter what happens, because you are a long-term investor, not a trader. Traders are the ones that get really caught up and worried about the day-to-day swings in the market. They're looking at what's happening next week and tomorrow and next month, versus investors are saying, well, if markets crash, I'm going to come in and buy more. If they don't crash, oh well, I'm going to keep looking for good opportunities, and you're looking for the opportunities to hold on for the long term, because it is impossible to predict what's going to come next. It's impossible to predict what the market is going to do because there are so many different factors that influence the market. On one hand, the stock market and the economy are similar but different. They're not linearly correlated. The economy can go up and the stock market might go down. On top of that, you also have external factors like the Federal Reserve Bank, which can influence the stock market. The Federal Reserve Bank can drastically raise interest rates and pull money out of the economy, and that would cause markets to crash. On the other hand, the Federal Reserve Bank could cut interest rates and they could start stimulating and pump billions, if not trillions of dollars into the market, causing markets to rally. You can't predict that. So instead of trying to trade your investments, actually invest in your investments. But if you really want to be able to understand where we're going in our economy and markets, you have to understand where we are right now, because right now we're in a situation where we've been facing red hot inflation. Yes, inflation has come down slightly, but it is still extremely high. The Federal Reserve Bank wants inflation to be around 2%, but what's been happening is our red hot inflation has been causing an economic slowdown. I'm going to label that ES. So the price of things have gone up so much because of this inflation that people are now cutting back on their spending. They're spending more money on their rent, their gas, and their groceries, so they have less money to go out and vacation and buy things at the store and do all that other stuff. So the economy has been slowing. Well, also because of this high inflation, the Federal Reserve Bank is also being forced to raise interest rates. So raising interest rates is a way that you combat inflation, because now you're pulling money out of the economy and you're trying to do deflation. You're trying to do the opposite of inflation. So the Federal Reserve Bank is working to fight inflation by raising interest rates. But there is a consequence of raising interest rates, because when you pull money out of the economy, that means there's less money out there that can be spent. And if there's less money out there that can be spent, well, that also contributes more to an economic slowdown. So the high inflation is contributing to an economic slowdown. The Federal Reserve Bank is raising interest rates, which is also contributing to an economic slowdown. And then we have the last factor, which has to do with the government spending. I'm going to put that over here, because the government spending is not slowing down. We still have a massive national debt, and the government is still passing more bills to increase spending, which contributes to more Inflation. This is what people are trying to forecast and try to trade on. They're forecasting what's going to happen with inflation. They're forecasting what's going to happen with the economic slowdown, and they're forecasting what's happening with interest rates. And based off of that, they're trying to predict what's going to happen in markets. Now, again, this is what traders do. You can make a lot of money in the short term, but it's also the highest risk. And over the long term, traders don't really make that much money. Investors understand this bigger picture, and now all you're doing is you're trying to find the good opportunities. That way you can buy them at an undervalued price and hold on to them for the long term, because if you believe in the American economy, well, that means that over the long term, that your company, your investment would also go up as long as it's a good company that continues to produce more value. Now, if you're looking for a way to actually invest your money, before I get back into this, you want to have a good tool that will allow you to invest your money. You can check out our sponsor, FTX US. The nice thing about FTX US is that not only can you trade stocks on their platform, but you can also trade cryptocurrencies and NFTs right off of their platform. I've talked about this before, but crypto is much more speculative. It's much more risky. However, I do invest my money in crypto, but it is part of the speculative, risky part of my portfolio. So this is where you want to be an educated investor and understand why you're investing in certain things and how to actually invest in it. The nice thing about FTX US is that they make it super simple for you to invest your money, and they also make it super simple for you to dollar cost invest your money. Meaning you can invest your money one time into an asset, you can buy it once a week, you can buy it once a day, so you can pick your frequency and buy the investments that you like at your own schedule in a very simple fashion. And the reason why I like FTX US is because their fees are so much lower than pretty much every other major brokerage out there. So if you want to learn more and see how you can get started with FTX US, I'll put my link to how you can do it down in the description below. And the nice thing about FTX US is that if you use my link down in the description and then you enter in the referral code minority, well, after you trade $100 worth of crypto, they will also give you some free cryptocurrency just because you use my referral code. So if you want to learn more, check it out. I got my link for you down in the description below. What we know as of today is that our economy is slowing down. And on top of that, the Federal Reserve Bank is going to continue raising interest rates, which will continue to slow down our economy. We know that our economy is slowing down because we have seen 2 consecutive quarters, meaning 6 months of economic contraction in the United States. So we have the reports telling us that our economy has been slowing down for the last 6 months, although that is typically the definition for a recession. Nowadays, a lot of people are saying that that's not the definition that we want to use in 2022. So technically, we are not in a recession because it hasn't been announced that we are in a recession, but we've seen our economy slow down for the last 6 months. On top of that, the Federal Reserve Bank has made it very clear that they want to keep raising interest rates and that they want to stay on this plan until they can bring inflation down to 2%. So I'll write that over here. This is target inflation for the Federal Reserve Bank. Right now, we're at 8.5%, and the reason why inflation fell as much as it did over the last month was because gas prices have fallen so much. Now, if you looked at the CPI report, the inflation report, I talked about this in a video that I made recently. What it also said is that yet other aspects of the inflation report, like groceries and housing costs, that have grown even more significantly. So yes, gas prices fell pretty hard, but 8.5% inflation is still record high inflation. It is extremely high inflation, and so people are still feeling the pinch because of inflation, which is contributing to more economic slowdown. So now the question then becomes, how aggressive will the Federal Reserve Bank be? Because again, the stock market and the economy are similar, but they're not linearly correlated. We saw this in great detail in 2020, where at first the economy was shut down and markets collapsed. They were completely linear. And then we saw the Federal Reserve Bank open up the money printer, and then people started to spend. Now markets started to rally, but the economy was still in the worst economy since the Great Depression. So we had the economy going down here, but markets were rallying. So you can have this type of discrepancy between markets and the economy, especially in the short term, but over the long term, what you see happen is that the economy and the stock market start to linearize, if that's a word. They start to come together, and that's when you start to see who really understands what they're doing with their money. Because when you have bull markets, when you have markets that are just straight going up, it's very easy for everybody to think they know exactly what they're doing. They know that they're a financial genius because everybody's making money. But this now brings us to a very unique time today, because now our economy is slowing. And now a lot of people are predicting that the Federal Reserve Bank is not going to stay true to their word. What they're saying is, yeah, we understand that the Federal Reserve Bank says they're not going to stop raising interest rates and they're not going to stop fighting inflation until we bring it down to 2%. But we don't actually think that they're going to do that. So you have a lot of traders in the market that have been buying because they believe that as inflation starts to come down a little bit, the economy is also going to slow. And as the economy slows and unemployment goes up, the Federal Reserve Bank is going to change their mind. They're going to say, yeah, you know what? Our target has been 2%. But we've come down significantly since our highs of 9% or something. And because we've come down so much from inflation, inflation is under control, is on its way down. But now our bigger concern is this, the economic slowdown. So if 6 months from now or 12 months from now, we start to see unemployment start to grow, while inflation hasn't come down to 2%, you have a lot of people believing that the Federal Reserve Bank is going to use that as a reason to now cut interest rates. They're going to use it as a reason to stimulate, which will then pump up the markets. And that's why traders have been buying a lot of stocks. They've been putting a lot of money into the market because that's what they believe is going to happen. Now, again, I'm going to say this another time. I'm not a trader. I'm not advocating for you to be a trader. What I'm saying is understand all the stuff that's going on and create a strategy for you. I've talked about my active and passive strategy many times. My passive strategy is where every week, for me it's Wednesdays, I have a strategy where I have money leaving my account and automatically being invested into a number of different ETFs. This happens whether the market's up or the market's down. It does not matter. It always keeps happening, and I'm just buying up shares. When the market's down, I get to buy more shares. When the market's up, I'll buy a little bit less, but I just keep buying more shares of the ETFs or the companies that I want to own. Then I have an active strategy, which means when times are okay, I'm researching the investments that I want to own. So you start spending your time looking for the right companies. You start researching the companies, you listen to earning calls, you find the companies that you want, and now all you're doing is you're waiting for a good buying point. You're waiting for a good price. And so if things continue to go down, well, now you have a great buying point for you to come in and buy because you know this is a good company. You've already done the research and you're prepared, meaning you've put cash aside to buy this investment. So this is all about preparing when times are okay to take advantage of opportunities when times are not okay. So it's about preparing now for if things continue to go down, that's when you can come in. Now, I do think that we have a lot more pain ahead in our economy, but I don't really try to predict that. It doesn't matter to me. Because what I'm trying to do is I have a good strategy, I understand the economy, I understand what's going on, and now I'm just waiting for a good buying point. If people are getting anxiety and stressed over every little detail that's happening in the markets, it's going to be very hard for you to make a rational decision because no good investment decision happens out of emotion. No good financial decision happens when you're anxious or you're greedy or you feel scared. This is where you want to cut the emotion out and start to understand your strategy. Get financially educated and take the emotion out of the equation. That way you can make better financial decisions for you, your family, and your community. Now, to be completely transparent, I'm not doing that same active strategy now like I used to. It's not because of what's happening in the markets. It's just because of what opportunities are out there for me. For me right now, I have a better opportunity for me to invest my money back into my own business, Market Briefs. So I've been having less money to put into the market because I'm just investing more aggressively into Market Briefs. But if I don't have to invest my money into Market Briefs, once it becomes bigger, once it becomes more stable, and I understand that I don't need to keep investing my money back into Market Briefs, then that would be an opportunity for me to then continue to actively invest my money back into the markets. But that's just what I wanted to let you know because I did make a video talking about how I'm not investing my money actively into the market like I used to. And it's not because of what's happening in the markets. It's because of what's happening in my own personal financial situation where it's a better opportunity for me right now. You mean if I just put $1,000 into this investment, I can double it in 6 months? Sign me up. Then you have people who have no idea what they're doing start buying, and this causes a big bubble. So you start to see these booms and busts in paper assets, which can create opportunity for the people that understand what's going on, but it hurts the people who don't understand what's going on. It hurts the people who are not financially educated.